if you're going to domicile manufacturing in the United States, the relationship between Canada and Mexico, or with Canada and Mexico, are critical, meaning we tend to source goods which are helped by cheap labor from Mexico and cheaper natural resources from Canada. And so you have these hubs like the one you mentioned in New Mexico that have been situated to facilitate integrated logistics and supply chain arrangements, other import-export arrangements, which are critical to North America and have allowed North America on the margin to take share from Asia. And so the recent tariff events have basically put sand in the gears of some of those relationships and made it more challenging.
These are the granularities, folks, that are so important. Robert Kaplan, when you were running the Fed in Dallas, did you ever visit the LVMH factory in Alvarado, Texas?
I don't think I did, but I visited lots of sites north of the border and south of the border, and I learned about the velocity, the frequency of goods going back and forth across the border.
What do you have a confidence we can supply an American manufacturing? Folks, Bob Kaplan is one of the most qualified people on this question I know. He's a business guy working in economics. Robert Kaplan, can we actually develop a skilled American manufacturing working force?
We can develop it, but it's expensive. That's the issue. Most companies I talk with want to be able to use either Mexico, Canada, to some extent even Vietnam, which is more farther afield, but they use these logistics and supply chain arrangements because if you did it all in the United States, their judgment is because costs are higher, that it would not be globally competitive. This allows them to domicile in the United States, predominantly manufacture in the United States, and if they didn't have those relationships, it would be harder to do.
Damian Sassower with me this morning, Robert Kaplan here, expert on EM in the Pacific Rim as well with Bloomberg LP. Damian?
Mr. Kaplan, sir, I'd like to ask you about global growth, right? I mean, as Tom just pointed out, right, we are seeing a weaker dollar, weaker oil. We are seeing fiscal stimulus out of the U.S., China, and the EU. And more importantly, we're seeing monetary stimulus out of the emerging markets, right? Because, basically China's dumping in a lot of them, and they're basically suppressing, inflation domestically. Isn't this good for global growth? I mean, walk me through this.
Yeah, so going into this year, we had a oversupply, and still do, of goods globally. China overcapacity is a big part of that story. So goods have been disinflating, including, by the way, in the United States. The inflation issue was in services, not in goods. The global goods disinflation continues, except there's a question whether it will continue in the United States because of what we do on tariffs. But the fact of the matter is we've had this goods oversupply. What the tariffs have done is cause businesses around the world, and particularly in the United States, to pause and be more uncertain as to how they're going to redo logistics and supply chains. Remember, only 12% of U.S. GDP is manufacturing.
Right.
We import another 12% in goods. We're basically a service economy, but these tariffs have created uncertainty in both goods and services, not just here, but globally, which have put a damper on growth. And that's what you're seeing.